Hey guys, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Thanks for joining me today, again for another video. And of course this is a video series we're doing to complement the Undervalued Dividend Growth Stock of the Week articles, which we've been doing the articles, if you can follow my screen here. We've been doing the articles since 2014, so going on a few years now. And of course, if you're at the Daily Trade Alert website, dailytradealert.com, you enter the Dividend Growth Investing heading there, and then you can click on the tab there for Undervalued Dividend Growth Stock of the Week, and it'll give you the archive of all the articles. And a few months ago, starting back here, you can see with Magna here back in May, so a few months now, we started doing a video series where I go through the actual article and show you where some of the ideas came from, where the numbers came from, trying to complement and add value to the articles, showing where the conclusion came from at the end. And that way, instead of just reading an article and browsing through it and saying, okay, well, you know, the stock might be worth this much, instead of thinking, oh, well, where did this idea come from, or where did this conclusion come from, you can actually follow along with this video series and see where some of these ideas are coming from, see these concepts put together in real time while watching the video. So it's going back through the article, going back through the numbers, and keeping myself honest too. So you know, there's nothing made up here. I'm not making these numbers up, not pulling them off the top of my head. These are coming from financial statements, coming from professional stock analysts and things like that. When I actually show the different professional stock analyst valuations, comparing them to my own, and then I average them out at the bottom, you'll actually see where everything comes from. So getting into it today, we've got so with each video that I do, I pick one of the recent articles that I wrote, and then I choose that stock to go through and choose that article to go through and look at the numbers and show everything. So for this week's video, we're looking at Williams-Sonoma, which if you're under the Undervalued Dividend Growth Stock of the Week and you're looking at the archives there, you can see that it was the most recent article. So it was published on August 27th, which means that I would have started writing the article probably about a week beforehand. And Williams-Sonoma was actually interesting because I started writing the article, let's see, today's the 29th. I started writing the article, it was published on the 27th. I believe I started writing it on Monday the 21st, if I'm not mistaken. And then earnings came out in the middle of that week. So I had to actually go back through and edit some of the numbers because, you know, I don't know off the top of my head. Whenever I'm writing these articles during earnings season, a lot of times, you know, I don't know what the exact date is for every single stock that I'm writing about in terms of when its earnings are coming out. So I have to sometimes kind of keep an eye on that. And with Williams-Sonoma, it was interesting because earnings did come out, so kind of affected some of the numbers, and then I reflected everything back in the article and everything like that. So getting to the article, if you click on it, it'll take you to the article, which I already clicked on it and already have it pulled up here. Again, each article starts out with a big idea, trying to describe why you readers should be interested in the article in the first place, and then also what makes dividend growth investing special, why this investment strategy makes a lot of sense, you know, trying to kind of show you the buy-in in terms of, you know, why you should be interested in some of these ideas that I'm about to present, why you should be interested in the investment idea that I'm going to present as well. So the article, this week's article, I kind of talk a little bit about risk, about perceived risk. I think what risk is and what people perceive risk to be are different, and I talk a little bit about that. And I kind of argue that the biggest risk in life is not taking risk. So, you know, when I first started investing back in early 2010, a lot of people in my life thought that investing in stocks at all was a risky venture or a risky prospect, and that I was risking a lot of my money. But when you look at the long-term average return of the broader market, and then you start looking at the long-term returns of some of the stocks that I'm buying, some of the high-quality dividend growth stocks that I buy, and these businesses that I'm invested in, you see that the real risk is not putting your money to work. The risk is actually putting your money in the bank or something like that, knowing that for sure you're going to lose wealth to inflation. You know, your purchasing power is going to decrease over time. So you might not perceive it to be that way because you look on a statement and see the same balance, or roughly the same balance that was there last month and the prior month and the month before that. You think, oh well, I'm not really losing any money, you know, I feel safe. But you are losing money, and it's that's the thing, is perception is reality. And if you perceive these things to be risky, if you perceive investing to be risky, if you perceive going after financial independence to be risky, then to you it is risky, but it's really not when you start to reframe that perspective and then you change that perception. So I talk a little bit about that in the article, and obviously why you shouldn't just be interested in dividend growth investing or dividend growth stocks, but specifically high quality dividend growth stocks that are undervalued at the time of purchase, and talk a little bit about the benefits that are conferred to the investor, which include higher yield, greater long-term total return potential, and less risk, and how that plays out there. So the stock for this week, the undervalued dividend growth stock that I chose, is Williams-Sonoma, which is a retailer of high-end products and furnishings. They're known by a number of different brands, which include Pottery Barn, primarily Pottery Barn, West Elm, and Williams-Sonoma. So you're talking about, especially with like Pottery Barn and West Elm, you're talking about basically furniture, high-end furniture, so couches and chairs and tables and things like that. And then when you're talking about Williams-Sonoma, you're getting a little bit of that as well. But in addition to that, a lot of high-end furnishings like cookware, knives, plates, and things like that. So they're known for their high quality, high-end furnishings, and they've built actually more than one brand, a few brands around that, which again, Pottery Barn, West Elm, and Williams-Sonoma, they built some brands around those high-end furnishings. And because of the, again, perhaps perceived quality, but I would argue it's not just perceived quality, they are high quality products. They charge a premium for these high quality products. They built a brand around these high quality products, and thus they're able to charge a premium for their high-end, high quality products. And that's really where they make their money, is based on that brand, based on that perception that their products are better than a lot of the competition, and that puts Williams-Sonoma, Pottery Barn, and West Elm into that upper echelon when you start thinking about home furnishings and furniture and things like that. So even with all that, though, even with the brand quality of those brands, and even with the company being so well regarded when it comes to, if you're buying a fairly large house, if you're a typical American consumer, or maybe even an atypical, you're a higher end consumer, and you're driving around a BMW, you live in a nice house, you're not gonna furnish your house with furniture from Target. You're going to get the nice stuff. You want your nice house filled with nice furniture, and there are only really a few competitors in that niche. So when people talk about e-commerce and they talk about Amazon taking over things, it's to be argued. Depends on your perspective, depends on your opinion on that. But when I think about the typical consumer, the typical Williams-Sonoma or Pottery Barn or West Elm customer, are they going to be buying their couch from Amazon versus West Elm, or versus Williams-Sonoma? Are they going to be buying their cookware from there? And I don't know. I think that argument would be hard to make for a lot of those customers. Now, is a customer who would typically be shopping at lower end or retailers without that kind of brand name? If you're a typical Walmart shopper, or maybe even a Target shopper or something like that, are you maybe going to be buying your furniture from Amazon? Maybe so, yeah. So it's a different customer that I think Williams-Sonoma and West Elm, Williams-Sonoma is the company, but the brands Williams-Sonoma, West Elm, and Pottery Barn, I think those brands are going after different customers. So that's something to keep in mind when you think about e-commerce. And there's another part of the puzzle here with Williams-Sonoma that I think is really important to keep in mind, which I'll get into in a little bit, in terms of the ongoing retail changes and challenges regarding the switch from traditional B&M retail to e-commerce. So that's getting a little bit into the company and what they do. The next thing I get into with the article, obviously, is the dividend metrics, and specifically how long the dividend's been growing for, the dividend growth rate, the payout ratio, and the yield. So those are 4 key metrics that every dividend growth investor is going to want to know about. So Williams-Sonoma has been growing their dividend for 12 consecutive years. They've been increasing it for 12 consecutive years. And when you pull up David Fish's Dividend Champions, Contenders, and Challengers list, you can search for any stock ticker you want or scroll through, but I just usually do a quick search. And you see Williams-Sonoma here, WSM stock ticker. They've been increasing their dividend, consecutive years of dividend growth. You see 12 years right there, which is pretty solid for a retailer like this. It's not the longest streak in the world, so if you primarily just invest in stocks with 20 plus years, say, then Williams-Sonoma might not qualify. But I think that portends good things. I think it bodes well for future dividend increases when they have that 12-year streak. And keep in mind that every 25 or 50-year streak of dividend increases has to start somewhere. It has to start with 5 or 10 or 15 years or whatever, and that has to start with that first dividend increase from there on out. So every journey of a million miles starts with the first step, right? So so they do have 12 years of consecutive dividend increases. They do seem committed to it, and they do have the wherewithal to continue increasing it. So with that dual commitment and wherewithal, again, I think it bodes well for continued dividend increases. Looking at the other metrics, the 10-year dividend growth rate, of course, is important to keep in mind. And you see right here 17.1%, which I reflected in the article right here, the 10-year dividend growth rate, which is huge, massive. But that, keeping in mind that 10 years ago, Williams-Sonoma only had a 2-year streak of increasing its dividends. So the payout ratio is obviously quite low. And if you want to kind of see what it might have been back then, you go to Morningstar, pull for key ratios. You can look at the payout ratio way back when. This was early 2008. So this is going back a decade, basically. You're looking at a payout ratio of 26%. So that dividend growth rate of 17% has come, you know, I don't know if I'd say primarily, but certainly there's a significant portion of it that has come about due to the expanding payout ratio. So Williams-Sonoma has expanded its payout ratio, which has afforded it the ability to increase that dividend at a very, you know, at a rate well into the double digits. Is that going to continue going forward? I would argue not, and I'm going to get into why I would make that argument as the article goes on. But it's still a great long-term dividend growth rate, 17.1%. Again, it certainly shows that there's a commitment there. They've had that wherewithal to be able to do that. Again, due, at least in part, due to the ability to expand that payout ratio from 26% to where it's at now, which is the next area I get into. The payout ratio right now is 45.3%. Again, a decade ago it was 26, so it's almost doubled over the last decade. And if it were to double again in another decade, the payout ratio would be 100% effectively. So they're not going to obviously continue growing that dividend at that kind of rate unless the company were also growing at 17%, which it's not. So the dividend growth going forward is going to be much lower. You know, and I get into what I think it's going to be over the long hauls as we go throughout the article, but just keep that in mind. That payout ratio has expanded, which has fueled a good chunk of that dividend growth, but there's still a lot of room left. I mean, 45.3% is still a relatively low payout ratio if you look at a lot of the stocks out there with you know, long-term dividend growth streaks and fairly high yields. You see a payout ratio generally a lot of times in the 60-70% range. So a payout ratio of 45.3 is still pretty solid. I mean, I consider, again, as I've talked about numerous times, I consider the perfect payout ratio of 50%, because that's a perfect balance between retaining earnings to continue to grow the company, be it, you know, reinvestment or M&A or whatever it might be, and then you have that other 50%, which is profit going back to the shareholders, which, you know, shareholders are the owners of any publicly traded company. So the owners say, hey, we want our share of whatever profit you're generating, but we also want to continue to see the business grow so that we can continue collecting those growing dividends for years and years and years to come. And you have to kind of balance those two out. Williams-Sonoma is doing a pretty good job right now, obviously. I mean, it's below 50%. There's still plenty of room to grow that payout ratio, in addition to whatever dividend growth would be available through organic growth of the company. So if the company's growing at 7-8% and there's still a little room to grow that payout ratio out a little bit, you could easily get up into maybe coming up into, you know, maybe double-digit dividend growth for the next few years at least. But again, I would expect that dividend growth to come way down. And one thing always to keep in mind when you're looking at the dividend growth is to look at an acceleration or deceleration in dividend growth. And you see here the massive deceleration. So the 10-year dividend growth rate was 17.1%. You see the 3-year dividend growth rate here at 8.3%. And then the 1-year dividend growth rate at 5.8%. The most recent increase was about 5.5%. So you see a dramatic slowdown in terms of dividend growth there, which makes sense when we look at some of the growth of the company, the underlying profit growth. That makes a lot of sense. That said, again, with the payout ratio being fairly moderate right now, and with the company still growing in the mid-single digits, this kind of dividend growth here, 5.5%, I think is really on the low end in terms of what to expect moving forward, at least over the next 5 to 10 years, just because they do have so much flexibility, as we'll get into. So one other key metric to keep in mind, obviously, is the yield. That's the last metric I look at. Generally look at those 4 metrics. which again is the number of years of dividend growth, the track record, the long-term dividend growth rate, the payout ratio, then the yield. And again, when you're looking at dividend growth stocks out there with this kind of yield, we're talking 3.5% almost. And what is it yielding today? Because I wrote this article over a week ago. It's 3.39. So the stock has climbed a little bit since I wrote the article. Because as price rises, yield falls. Price and yield are inversely correlated. So all else equal, as the price increases, the yield will drop. So that when you see that lower yield there compared to when I wrote the article, the price has obviously moved up just a little bit. But still, 3.5% yield on a company with a fairly moderate payout ratio and a pretty strong dividend growth rate here, looking out over the long haul, that's a lot to like. I mean, even if they're only able to grow the dividend, you know, in the mid-single digits or maybe upper single digits, say 6-7%, that still paints a pretty good picture for current income and income growth, which also translates into total return. All else, if the valuation stays static, if the PE ratio stays static, then generally your total return is going to be the sum of the yield and the dividend growth percentage. So if you get a yield of 3.5% and you're getting dividend growth of 7%, that lines you up for about 10.5% annual returns. Again, assuming that the valuation doesn't expand or contract. But pretty good numbers here. And when we're looking at that yield, and in terms of valuation of the stock, I always look at where's the yield at today compared to where it's historically been, or at least over the recent historical numbers. And pulling that up, if we go over to the valuation tab for Morningstar here, you can see where the yield's at and where the yield has typically been on average over the last 5 years. So we see that yield at what, we're at 3.39%, 3.4% we'll call it. The 5-year average yield for this stock, you see right here guys, 2.2%. So we're looking at a, we're looking at a spread of what, almost, what, 100, yeah, we're looking at 120, over 120 basis points compared to where it has been on average and where it is. 220 versus 340, that's 120 basically. So that's a pretty significant spread. So what this means is that on average over the last 5 years, and when investors have bought Williams-Sonoma stock, or when they've been willing to buy Williams-Sonoma stock, or willing, where the market has valued Williams-Sonoma stock, the yield has been 2.2%. So investors have been willing to accept, on average, a yield of 2.2% over the last 5 years. And what they're accepting now is 3.4%, which is a pretty big spread. So what we're saying is Williams-Sonoma was worth a yield of 2.2% before. Now we want that higher yield. It's worth less now. And it's not just a little bit of a change, it's a very large change. I mean, we're not saying that it's been 2.2 and now it's 2.4 or 2.5. It was 2.2 and now it's 3.4. And actually when I started writing this article, before it popped after earnings, it was over 3.5. So it was even over 130 basis point spread, which is pretty huge. And you see some of these other metrics here, right? Price to book 3.2, 4.5. Cash flow 7.4, 13.4. I mean, we're talking almost half on cash flow. Almost half. And that's a 3-year average on cash flow. Price to earnings, same thing, which we'll get into in the valuation section. But, has Williams-Sonoma deteriorated so much to where the cash flow is worth half of what it was before, where the yield is worth 120 basis points? There should be a 120 basis point spread between what you were typically getting on the stock and what you should get now. That's a pretty big call on the valuation. I mean, that's a major compression here. So I think that seems excessive, and I'll get into that as we go on. So I talked a little bit about the dividend metrics and where we're at there, which pretty solid. I mean, 3.5% yield, double-digit dividend growth over the long haul, 12 consecutive years of dividend increases, and a payout ratio that's pretty moderate. There's no reason why Williams-Sonoma shouldn't be able to continue growing its dividend at a high single-digit rate moving forward, and you're getting a almost 3.5% yield today, which is very appealing. I mean, there's not a lot of high-quality stocks out there where you're just going to be able to snap up a 3.5% yield no problem and get that undervaluation on top of it. It's not that often. So, especially if you're diversifying your portfolio, I mean, you could say, well, I'll just go after telecoms. I can buy AT&T and get a 5% plus yield. Well, sure, you can do that, but are you just going to have all of your money in AT&T? You got to spread things out. So if you already bought AT&T, but you still want yield and you want to be exposed to a different industry and a different business, especially if you want value, Williams-Sonoma seems to offer quite a bit there, quite a bit to like. So before we get into valuation, we first must know what kind of growth to expect. Anytime you're modeling out a valuation, if you're doing a discounted cash flow or dividend discount model analysis, you're modeling in what you think the future growth will be. And before you can build an expectation for future growth, you need to know where the company's already been. And I use 10 years as a proxy for the long haul. So when I extrapolate things out over the long term, I use the last 10 years as a pretty good look at what they've been doing over the long term, keeping in mind that the last 10 years includes a good chunk of the financial crisis and the Great Recession. So if anything, the last 10 years, in my opinion, is pretty conservative, especially with retail, with all the changes that have been going on with the change to e-commerce and how that's affected B&M retailers. If you want a challenging 10-year period to look at for a company like Williams-Sonoma, I would be hard-pressed to think of a more challenging period than the last 10 years. So when we look at some of these numbers, if they come out pretty solid, knowing all that, knowing that that's happened over the last 10 years, I don't know, that seems to bode pretty well moving forward. If you're just going to say, well, over the last 10 years they grew at X, but that included the financial crisis and Great Recession, that included all these massive changes in retail, and they still grew at a pretty attractive rate, which we're going to look at, that's something to like. So the first thing we're looking at is revenue, and I'm going to pull up the financial statements here. I went to Williams-Sonoma Investor Relations and pulled up their annual reports. Last 10 years, I went to 2007, 2016. And before I get into those numbers, before I get into revenue, that reminds me, I wanted to talk a little bit about a point I made earlier about the change to the shifting winds to e-commerce and how that might affect a company like Williams-Sonoma. I think that part of the competitive advantages, the economic moat for the company, is their customer base. I think that's one area of protection for the company, but a much larger piece of the puzzle here for Williams-Sonoma is their already existing exposure to e-commerce, which they have a framework in place that very few other retailers, traditional retailers here, I'm talking legacy retailers, have in place. And that is a substantial e-commerce business. So this is their 2007 annual report, guys. And you can see here the revenue, how it breaks down for their fiscal 2007. You can see retail revenues, $2.2 billion, right? You see direct-to-customer revenues, which they've renamed since to e-commerce to reflect kind of new lingo or whatever you want to call it. But DTC here was $1.6 billion. You see the percentage breakdown right here. So retail at that point, at that time, was 57.8% of their sales. Direct-to-customer or e-commerce was 42.2%. When you pull up 2016, guys, check this out. E-commerce 2.6, retail net revenue 2.45. So e-commerce is now over half the company's revenue, whereas just 10 years ago it was 42.2%. So we see what's growing and what's maybe not growing so much. You see retail net 2.45, you see it here at 2.28, and look at direct-to-customer e-commerce 1.6, 2.6. So we see not only what the larger half of the business is, but also what's growing the fastest. The answer to both those queries would be the e-commerce segment of the company, so which is really fantastic. So I'm going to get back into the numbers here for the company here, and again I'm gonna scroll down to their actual financial statements here, but you can already see the net revenue here, 3.944 billion, which I just rounded, but I'm going to scroll down to the actual financial statements, so we're looking at apples to apples here. I just wanted to pull that up so you guys could see where the company's been and where it's going, where it's probably going moving forward in terms of e-commerce sales and everything. Okay, so you see here net revenue 3.944 billion, which you see right here 3.945 billion. I just rounded that, 3.9449, so that rounds to a 3.945. And then we see the revenue here at 5.083812. I rounded it to 5.084, and you can see where that rounding came from, right? The 812 here, 8 goes to 3, goes to 4, and then when we're trying to figure out the growth rate of that, I use the Investopedia, as I've talked about in prior videos. I use the Investopedia compound annual growth rate calculator here, which you see here, investopedia.com. You can use any compound annual growth rate calculator you'd like. I like this one, but they all work the same. So when we're looking at these numbers, 3945 and 5084, right? Whoop. And it's 9 compounding periods because although it's 10 years of data, the first piece of data, the 2007 data, is not a period of growth, it's a starting point. So it's a compound annual growth rate of 2.86%, which I reflect right here. And I noted that that's a little disappointing to me. When I'm looking at a mature company, and I would qualify Williams-Sonoma as being mature relative to its industry. They're a pretty large company in furniture and furnishings, high-end furniture and furnishings. I'm usually looking for mid-single digit growth on the top line, so anywhere from, say, 4 to 6, somewhere in that range. They came out a little below that. It's not a huge deal, but it's a little disappointing. So when I'm writing these articles, I try to be fair. I'm not trying to be biased or anything. I'm a shareholder of Williams-Sonoma, so I'm not just trying to talk it up or anything. The revenue, I would like to see a little higher number there. And, you know, Williams, again, talking about what I said earlier, the last 10 years, if you want to think of a challenging 10-year period for Williams-Sonoma, it'd be hard to think of one that's been more challenging over the last 10 years. So I give them a little bit of a, benefit of the doubt there when I'm looking at that top line growth. Still, I would have preferred to have seen something maybe somewhere in the 3.5% to 4% range, which would be on the lower end of that mid-single digit growth that I tend to look for. But it's not that bad. The bigger concern, of course, is earnings per share growth. That's where that dividend growth is going to come from. That's really the bottom line. You know, if a company's growing revenue at a huge rate but not growing any profit, or not generating any profit, or not growing its profit, then, you know, there's a certain company by the name of Amazon.com that bucks that trend, and they're the exception rather than the rule. But usually that's not a good thing, because there's nothing there's actually nothing to show for the business if you don't have any profit. I mean, that's a, generally speaking, usually speaking, that's a path to insolvency at some point. I mean, you can't just indefinitely not produce any profit. Amazon turned that corner because they have the cloud business, which has become humongous for them. But if they were still relying just on retail, something would have had to have changed by now. You can't continue like that on forever. Nonetheless, getting back to the earnings per share growth and pulling up the financial statements here, you see the diluted earnings per share here at $1.76 in 2007. And then 2016, we see here diluted earnings per share at $3.41, which I should have reflected in the article, 176 to 341. And then just looking at the growth, again, 9 periods. We're looking at compound annual growth rate of 7.63%, which I reflected right here on the bottom line. That's pretty solid. You know, when you're seeing something like that, when you see there's excessive bottom line growth, or you see excess bottom line growth relative to the top line, then you're generally looking at one of two answers for that. If that's a question, you know, where did this excess bottom line growth come from? You're generally looking at either share buybacks and or some type of margin expansion. And if we go back to key ratios, and actually you can pull it up here when you see the shares, the diluted shares here, 111 right there. And you see 89 right here. And Morningstar, as I've talked about before, is usually pretty accurate. You got 111 here, 89 here. So you went down from 111 million. I'm sorry, 1.1 billion. Would that be what it is? No, that's right. Yeah, 111 million. I'm sorry, 111 million to 89 million. So they've dropped their outstanding share count. If you want to do the math here. By about 20%, which I think I reflected in the article here. Yeah, right here. Meanwhile, the bottom line growth over this period was much better, thanks largely to a reduced outstanding share count, down by almost 20% over the last decade. And as I said before, margin expansion you'll sometimes see, but that really hasn't been the case here. Their margins are pretty much static here. Operating margin you see here, there's maybe some expansion there. Net margin is really the one I care about, because that's kind of bottom line, out the door, what's the actual margin. And you see here they were kind of muddling around here in this, we'll call it maybe a 5% range, and they're now up in the 6s. So there's been some slight margin expansion, which is good, but most of that excess bottom line growth has really been fueled by the share repurchasing, which saw the outstanding share count down by about 20% over the last decade, which is pretty significant, especially for a mature company like this. I mean, you know, 1/5 of the company in terms of the number of shares outstanding, they're gone. They're just completely gone. So that's pretty significant. And I talked about the most recent result because earnings came out after I started, actually after I already put the article together. I had to go back in and edit some of the numbers. The earnings came out. Same store sales growth was 2.8%, very solid growth. The quarter prior to that, I think, saw almost nothing in terms of same-store sales growth. So people were concerned about that. The stock tanked, and then the stock popped after this earnings because they're back up to where people think they should be. Or when the analysts come out and they come out with forecasts, they were forecasting for right around that number, and that's where they came in at, which is great. And that's the thing with retail. I mean, one quarter can be one quarter can be fantastic, and that's the thing. Same thing with any business, really. If you're just looking at one quarter and making some kind of long-term projection, saying, well, this quarter came out, it was terrible, this business is junk, that's not really a good way to think about investing, because quarter to quarter, businesses can change, things change, the economy changes, consumer sentiment changes. I mean, you can't really dance in and out of the stock market dance because of one quarter or 1 month or one headline. You really have to look at the long-term numbers. You have to look at where they've been, where you think they're going to go, value that out, discount it back to today, and that's where you start to draw some conclusions. And so we looked at what they did over the last 10 years, the most important number being the 7.63% compound annual growth rate for the earnings per share, which is pretty solid. I mean, we're getting up close to 8% on a fairly mature business with a lot of challenges, as I spoke about earlier, over the last 10 years. Again, keeping in mind that that included the Great Recession, the financial crisis, and the changes in retail, but also the fact that Williams-Sonoma has adapted to that. They've made the changes that I think any shareholder would want them to make, saying, hey guys, we need to really be strong with the e-commerce exposure. People are buying online, people want to shop online. We need to do something about that. Williams-Sonoma said, yeah, we got it. It's over half the business, guys, we got it. So if you're looking at retail and saying, well, all legacy retailers are junk, they don't have any exposure to online sales, and that's just not the case. Again, just like you don't want to use one quarter to make a long-term conclusion, you don't want to just automatically assume that every retail company is the same. They're not all the same, as we can see here with Williams-Sonoma. They're still growing at a very good rate. The most recent quarter, as I talked about, you had the pretty solid same-store sales growth, and then earnings per share growth was 5.2% year over year, which is a deceleration from what we see here. But again, I'm not overly concerned about that. I wouldn't draw a conclusion from one quarter. But it's just a pretty solid quarter all in all, and the stock popped quite a bit, as it probably should have, because it was way down there. I mean, it was almost as if the company was just indefinitely going to struggle, and that doesn't seem to be the case at all. Now, when we look at trying to build an expectation for future growth and extrapolate some things out, again, the first thing we want to look at is where the company's already been, what it's been doing over the last 10 years, using that as a proxy for the long haul, and then looking at a forecast moving forward. And I use CFRA for that. Again, as I've spoke about in prior videos, CFRA seems to change their information all the time. And actually, you see here August 23rd, they have a date on there, which I don't really know if that's all that accurate. So yeah, that would have been Wednesday. They changed their information. I think I went on Wednesday and looked at this, and it might not. Yeah, 5:19 p.m. I see that too. They might not have had some of this information in here. So if any of these numbers are different, that's because they went in and changed it just a few days before this article was published, and after I'd already put the article together, and after I'd actually went back and edited it, because I think I went back and edited it before that timestamp. But they have the 3-year projected EPS compound annual growth rate. So basically what this number here is, this 9%, CFRA is saying they believe over the next 3 years that Williams-Sonoma is going to compound their earnings per share at a 9% annual rate. When I wrote the article, when I looked at things, they had it at 10%, so they've come down a little bit, which I really think they should. As I noted in this article, I said that's an aggressive forecast. I don't think they're going to be at that 9-10% mark, but even if they come in at 7-8%, which is where they've been at over the last 10 years, that's still a pretty solid growth rate. And as I note here, if they come in at, say, 7% compound annual growth rate for their earnings over the next 3 years, and they fall well short of that 9-10% mark that CFRA is putting in there, that still allows for like dividend growth, if not more, because of that modest payout ratio. So if the company's growing at 7%, the bottom line is growing at 7%, the dividend can easily continue to grow at 7%, and that's with a static payout ratio. That's not with the payout ratio expanding or compressing. So they could even afford to grow that dividend at, say, 8% or maybe 9% and just move that payout ratio up just a little bit. But if they want to just keep it where it's at, keep a very moderate payout ratio in place, and just allow for like dividend growth, then even if they fall short of that 9% forecast, there's still room there for 7% plus dividend growth. And as I talked about earlier, when you have a yield of 3.5% and you're getting dividend growth of 7%, that paints a pretty solid picture in terms of income growth, total return, and everything else. And looking at the rest of the fundamentals, of course, the two main areas I look at is the balance sheet. I take a look at long-term debt to equity ratio and interest coverage ratio, and then we look at profitability. And one other excellent area of this business, which provides a lot of flexibility when thinking about the dividend growth moving forward, is the balance sheet. The company has no long-term debt, and you can see that they never really had much, but they just paid it off and got rid of it. But you see here the long-term debt here back in 2007. You see here, when you go down to the most recent, I think they have it in here, yeah. When you look at the most recent balance sheet, it's gone. So you see here long-term debt, and they don't have any. And if you're ever unsure about that, or if you ever want to, where is the long-term debt? What's the long-term debt to equity ratio? A lot of websites out there will kind of clue you in or include those numbers, and you see here Google Finance right away pulls up a 0.00. So if you're thinking, well, where's the long-term debt? You see that, you're starting to kind of get the idea in mind that maybe Williams-Sonoma doesn't have any long-term debt. And I think CFRA includes that in their information too. Yeah, when you see long-term debt here, so yeah, they paid it off here at some point in 2014 because they had a very, very small long-term debt to equity ratio here. Way back when, I mean, that was almost nothing, but now it's NA. So you see here there's no debt. You see it on the financial statements, you see it on the various websites there. If you ever want to check with a third party, I mean, I always recommend going straight to the financial the financial statements for a company. Go right to the balance sheet. But if you were unsure, then you'd be able to see that elsewhere, that hey, there's just no long-term debt here, which again provides additional flexibility in terms of not only keeping the company solvent, keeping the company flexible for any continued changes in retail, how that's changing e-commerce. Again, they already have that framework in place, but also in terms of the dividend growth. If the growth of the company were to slow down, dramatically over the next few years, there's still a lot of flexibility with this company. A moderate payout ratio, you're still getting pretty good growth on the bottom line. You got no long-term debt. There's just a lot of levers in place that they can pull to keep things moving for shareholders. There's also M&A potential there. If they think they need to scale up, or if there's maybe a real nice niche bolt-on business there that has a loyal following, or some real small company they think they can bolt on, and that might be accretive. There's a lot of opportunities there, a lot of flexibility with no long-term debt, which is fantastic. I mean, one could argue that with interest rates being so low, maybe Williams-Sonoma would be better off with carrying a little debt, but yeah, I think they're in a fantastic spot. I mean, a lot of other legacy retailers, I don't know if I can think of any off the top of my head. Well, like Kroger, actually, I just wrote about Kroger not too long ago. They have quite a bit of debt. Macy's, if I'm not mistaken, has a pretty good chunk of debt too. So some of these legacy retailers that are maybe slowing down a little bit and facing new challenges have that debt to confront and deal with, on top of dealing with all the other challenges that have to go into the changes that are going on within their industries, their respective industries. Williams-Sonoma doesn't have that problem. They no long-term debt, one less problem to deal with. We can focus on what's in front of us, all the challenges that are in front of us, without having to worry about cash flow going to debt, or what are we going to do with all this debt, or it's just one less thing to deal with, which I think is fantastic. Getting into profitability, again, I use the 5-year average for return on equity and net margin, which you can see here. Net margin 6.38%. Return on equity 22.22%, and you see the numbers here reflected. Keeping in mind too that ROE is not only pretty solid in absolute terms, but also relative terms, not just to the industry itself. And you can see some of the other players here. Google Finance will usually include competitors. I don't know if there's a really good. I don't know if there's a really good example of who directly competes against Williams-Sonoma. I mean, I guess Bed Bath & Beyond might be one that you could kind of take a look at. You can see their ROE and their net profit margin kind of in that same range. Maybe a Restoration Hardware. They're super high end, super expensive. So I don't even know if that's a really good example. I guess Bed Bath & Beyond would be, off the top of my head, maybe one that kind of competes pretty well against Williams-Sonoma. In general, you can see some of the numbers there. You can see that they have quite a bit of debt, much lower yield. Profitability somewhat in line, slightly lower profit margin, ROE somewhere in that range. But again, I think Williams-Sonoma ROE is much more impressive considering that they have no debt. It's not juicing the ROE. Bed Bath & Beyond is basically right in the same range, but they have quite a bit of debt to carry as well. So Fantastic numbers, really. And you see a slight expansion, as we talked about earlier. You see the net margin here, kind of in that, if you look at the prior 5 years, you're kind of in that 5% range, maybe 5.5%, and now we're in that 6.5% range in the last 5 years. So they've definitely improved the business just slightly. And also they had debt before, as we saw, and now they don't. So it's a company that has become more profitable with less debt. You really can't get, and they have a greater percentage of the company's sales coming from e-commerce. I mean, it's improved. It's improved across the board. I don't see how anyone could say this company is worth less or is not as impressive as it was 10 years ago. They have more revenue, more profit, less debt, better profitability. It's just a stronger business, and that's with all of the challenges that have occurred over the last 10 years, as we spoke about earlier many times. So a lot to like. And on top of all that, with all those improvements that they've been making, the valuation is lower than what it's averaged over the last 5 years, which is astounding, right? That's why it's a good candidate for this week's article and the video that we're doing. So looking at the PE ratio, we're at 13.24 as of now, which it's 2:22 p.m. on the 29th. It was 13.10 when I wrote the article, just a minor change in the valuation. But when we compare that to where it's been over the last 5 years, as I alluded to earlier, the 5-year average PE ratio for this stock is 20.2. So investors were before willing to pay about on market, a market average for this stock, and now they're saying that it's worth much, much less than the broader market. You have the S&P 500 being way up here, their 5-year average being here, and where they're at today. It's way down there. I mean, it's basically priced for very little growth indefinitely moving forward, and I just don't think that's the case. The most recent quarter came out showing strong growth. The yield is very appealing. There's a lot of room for continued dividend growth. I don't think that this stock deserves to be in the bargain basement area of the valuation, but that's where it's at. You can see here the price to book ratio 3.2 compared to its 5-year average. Price to sales, same thing, less than 1. And then price to cash flow is a significant difference compared to its 3-year average, 13.4 compared to 7.4, and then the yield, as we talked about earlier. So, looking at those numbers, saying the stock, it was usually X, it's now Y, which is X minus, and you see the industry averages here. They're at a discount across the board. So you're saying the stock's worth less than the broader market, less than its industry average, less than what it's typically been at over the last 5 years. Where is the deterioration? Where is the significant deterioration to warrant that much compression? I mean, I think that, maybe as I talked about in the article, maybe you could say some valuation compression is warranted as the growth has slowed down slightly over the last, like I said, the quarter prior to the most recent quarter. They had some challenges with same-store sales growth. The bottom line growth wasn't that great. This quarter just came in. It looked pretty solid. Nonetheless, there's still a drop-off from where they have been. So if that continues, then sure. If you were valuing the stock at 7-8% growth over the last 5 years, and now you're trying to evaluate at 5 to 6% growth, somewhere in that range, then yeah, there needs to be some compression. But I mean, we're talking a significant drop-off compared to where it's usually been. So I note here that the stock does look cheap, but how cheap might it be? And then we do the dividend discount model analysis, as I always do. With this one here, it's a 39-cent dividend, is that correct? Google Finance tends to round, so I always got to check here. Yeah, it's 39 cents. So $1.56 a year. And then I used a 7% 7% growth rate on the stock and a 10% discount rate. So before I calculate this out, the reason why I'm using a 7% growth rate is because, as I've been talking about throughout the whole video, I think there's room for it. CFRA believes they're going to grow at 9% moving forward. They've grown at over 7% over the last decade. The payout ratio is below 50%. So even if Williams-Sonoma falls short of that CFRA forecast and comes in at 6.5%, could they not make that up, that other 50 basis points, that other 0.5% via the expansion of the payout ratio? Could they not do that for many years going forward? Absolutely. And if they come in at 7% growth, which would still be a large drop off from where CFRA predicts going forward, without any payout ratio expansion that would allow for like dividend growth. So the most recent dividend increase was 5.5%. The most recent quarter growth was somewhere around that range. So if that's a permanent change, then this would be probably too aggressive, because if they continue to grow the business at say 5.5% or 6%, you know, and then you want to say there's a full 100 basis point spread between bottom line growth and dividend growth, there's a full percentage point, then yeah, at some point that's going to affect the payout ratio. It's going to become too high. That's assuming the business is permanently impaired relative to where it's been and relative to where a professional analysis firm believes it's going to go. That might be a hard argument to make, to say, well, just based on the last couple quarters, we think permanently it's impaired. We're not even going to look at where they've been over the last 10 years, where they've been, where the dividend growth has been at over the last 10 plus years. If you're just looking at a very, very narrow set of data, then sure, you might say this dividend discount model analysis is a little aggressive, but I really don't think. I mean, when you look at the bottom line growth, you look at the dividend growth, you look at the payout ratio, you look at where they think it's going to go going forward, I think 7% is a pretty reasonable expectation. So we calculate that out. We get a fair value of 55.64, and again using the 10% discount rate because of the yield, 3.5%. I would only use a lower discount rate if the yield were over 4%. Once it starts climbing over 4%, or at least a few points above 4%, then I start kind of backing off that discount rate, because a bird in the hand's worth more than two in the bush, and a stock yielding 4, 5, or 6% is worth a little bit more to me based on collecting that current income, all else equal. So the DDM analysis gives me a fair value of 55.64. I talk a little bit about why I use that dividend discount model analysis, and then I compare that to professional analysis firms using Morningstar and CFRA. So Morningstar, they have their fair value here at 65 bucks. They have it as a 5-star stock, which you see here, 65 bucks, 5-star stock. And again, CFRA, they seem to change their data like every few weeks or something, or every couple weeks, even without earnings coming out. The numbers just seem to change all the time. So sometimes when I write this article, that, you know, the article might, between the time the article is written and the time it's published, there might be a week lag, and then the time between when the article is published and I do the video, there might be a week or two lag. So sometimes we're talking a 2 to 3 week gap here between when I'm going over the data and when the data was originally looked at. So sometimes these numbers change, but let's just see where they're at. When you're looking at the fair value, they have it down here on the third page. So they have it at 51.40. So they've actually increased it, which is, again, CFRA, I don't follow some of their logic sometimes, because we see here that they reduced their expectation for growth from 10 to 9%. When I originally looked at it, it was 10, now it's 9. Yet they increased the fair value of the stock from 50.40 to 51.40. I'm not quite sure where that comes in, why you would think a company that's going to grow at a slower rate than you originally anticipated would be worth more. But nonetheless, I think that they're sometimes their data seems a little weird, but I do like when you go through some of their rationale and their highlights, a lot of it's really right in line with what I tend to think about a lot of these stocks. I mean, when they think about, they go through a lot of the information in terms of what the business is doing, where they think it's going to go going forward, the valuation relative to peers, and a lot of this stuff is pretty good information. So it's not like they don't know what they're doing, and they're a global stock analysis firm, so I'm not questioning anything, but it's just weird sometimes with some of their data, how it changes so frequently, and then how one thing will go up, another thing will go down. But so I guess what I'm doing is I'm providing a reason as to why I use them and why I compare my numbers to them. I think they do know what they're doing. I'm just saying that sometimes the data is a little weird. But if we're going to go through and because this video is live, we're going to actually go through and reevaluate. So it's 51.40, not 50.40. And then my number hasn't changed, obviously. I'm using the same information. And then if we average those out, the valuation comes out to 57.34, which actually really, I mean, I'm not even really going to change this. It's extremely close to where I was in the article, 57.01. So the stock has popped a little bit since I first started writing the article. The valuation has moved up just slightly. Still, it's a significant discount, you know, where the stock is currently priced at relative to what I believe, what Morningstar believes, and what CFRA believes, what the stock is actually worth. There seems to be a pretty significant discount. But if we take that number, that 57.01, and we just keep it the same, it's 46 bucks basically. We're talking a discount of about 24%, which again, the stock has popped a little bit since I wrote it. Actually, when I first wrote this article, the stock was like 32% undervalued or something like that. So, but it had like a 4% pop on earnings. So I had to go back and edit some of these numbers. But you know, again, the stock looks 24% undervalued. As I'm doing this video, it looked 27% at the time that I submitted the article for a publication. You're getting a 3.5% yield almost, and pretty solid growth across the board, and a company that already is firmly entrenched in e-commerce, you know, sales. There's a lot to like with Williams-Sonoma. They got great brands, great dividend metrics, strong fundamentals, no debt, and then you get that undervaluation. I mean, there's a lot to like. I really don't know what you could find that's significantly wrong with the business. I mean, again, I think there might be some valuation compression warranted. You know, if the stock was typically valued at 20 times earnings over the last 5 years, and you see a big drop in short-term growth, you know, you might say, well, let's scale that back a little bit to maybe 17, 18 times earnings. I could see that, but to go from 20 to 13 over a very short period of time, that's a pretty strong move. You see here 13% down over the last year. I think actually if you go back just from like April, I think I noted in the article that the stock's down quite a bit just since April. Let's see, where did I note that? Oh, I did. I just noted down for the year. So yeah, when I wrote this article, it's down 15% for the year. It's come up a little bit because of, again, as I noted, that pop after earnings. But there's a lot to like with Williams-Sonoma, guys. I think it's a great retailer. It's got some of the best brands out there, great fundamentals, strong dividend metrics, great yield, great dividend growth, and you get the possibility for the 27% upside if price and value converge. You know, if that price, you know, meets the valuation, or what I believe the valuation is based on my valuation call, and then averaging out with Morningstar and CFRA. And you could make an argument that Morningstar is maybe a little aggressive with that $65. You know, I don't know if I'd say I don't know if I'd say this stock is worth $65 a share. I think that's being a little aggressive, because you would have to factor in a higher growth rate than what I used, or a lower discount rate, one or the other. And I just don't see a reason to do that. But you know, somebody came by and said, you know, the stock's worth maybe 60 or something. I could see it. I'm really quite comfortable with my number, which is almost 56, and averaged out it came out to 57. So I'm really comfortable with that number. I think it's hard to argue against that. I think it's hard to argue that the stock is worth much less. I think you can maybe argue that it's worth a little more, but to say that it's worth, you know, what it's priced at right now, 46 a share, I think that's a tough argument to make. So appreciate it, guys. Appreciate your time. I hope you enjoyed the video. As always, it's a pleasure for me to go over these numbers and to talk this stuff. I could talk stocks all day. In fact, usually when I'm done with these videos, my voice is a little hoarse because I've just been blabbing on and on for about an hour or so, which is about how long these videos usually last. There's no cutting, no editing, no cut, no take, no nothing. I just hit record and I just go. So I could do this all day long. I love it. And I appreciate you readers and viewers as well. This is something that's a great pleasure of mine, and I hope that it complements these articles. I hope it provided extra value for you. If you like the videos, you can give Daily Trade Alert a shout. You know, give them an email saying, hey, we love the videos, or send me a note just letting me know some feedback. That'd be great. If there's anything you want us to do differently or anything with that'd also be great to know. Appreciate it, guys. Have a great day. Thanks so much. Bye-bye.